Good afternoon, boys and girls. Welcome to the Liberty Call for Tuesday, April 26, 2022. Awful day in the markets. It was, as one of the headlines I'm going to read today, a bloodbath. So wasn't all that great if you're in equities. But again, I've been warning you people, this is this is around the corner. You can't, flood the economy with tons of money and then not expect, some major, snapbacks, the inflation, blowing up the bubble of the economy. And then everybody's walking around with pins getting ready to poke a hole in it. So, so we'll see, where things go long term. But again, it is wasn't a pretty day in the market. So, all right. Well, if it's your first time watching, give me a thumbs up, subscribe, a like, or whatever the hell they call those things on all the different platforms this gets disseminated on. So I'm a little late today. I apologize. I had to go get new tires for my wife's car, go get pick up mail from the office. And so I'm a little behind schedule. So, all right. Let's go ahead and jump into the indexes and take a peek and see how they did today. The Dow Jones finished down 2.38% at 33,240. S&P 500 down 2.81 at 4175. The NASDAQ was down 3.95% at closed at 12,490. Small caps were down almost 3%. The VIX was up nearly 20, just over 24%. Closed at, or it's sitting right now at 3352. All right. The other exchanges here in the Americas, Canada was down 1.53, Brazil down 2.23, Mexico down 0.36. Moving over to Western Europe, Germany was down 1.2, the UK was up 0.08, France was down 0.54, the euro was down, or Euro stocks was down 0.96, Netherlands down 0.51, Spain down 1.58. Italy down 0.95, Switzerland down 1.26, Portugal down 1.32, Belgium down 0.3, and as we get over towards Eastern Europe, Austria was down 1.02, Sweden down 1.58, Denmark down 1.42. The two Russian exchanges were up the MOEX was up 6.05, the RTSI was up 6.24. And then a bunch more reds. Let's see, I'll just point out the greens since there aren't a whole lot of them. The Nikkei was up in Japan was up 0.41. Australia was down 2%. Let's see here. As far as the Chinese markets, the Shanghai was down 1.44. The SESE component down 1.66. The China A50 was up 0.4%. The DJ Shanghai was down 1.41. The Hang Seng was up 0.33, and the Taiwan weighted up 0.14. And then a couple of these smaller ones were in the kind of mixed, a little more green, and I see red. So, but here in the U.S., we got our nuts kicked really hard. Probably the best way to put that, and keep it fairly clean. So, yeah, not the best day. So let's go ahead and read through a market recap. Dow in bloodbath as earnings disappoint and tech tanks. It's written by our friend Yassine Ibrahim over at Investing. The Dow fell Tuesday as weaker than expected corporate earnings and ongoing fears of a slowdown in global growth dented sentiment on stock, with tech leading the sell-off. Microsoft and Google fell more than 3% as investors aren't showing any willingness to stick around to find out whether earnings from big tech will help steady broader markets. In after-hours trading, Alphabet fell more than 7% after missing Q1 earnings per share expectations. Microsoft was flat despite topping Wall Street estimates on both top and bottom lines, led by strong growth in its cloud business. Apple, Meta were also nursing losses intraday, while Amazon Inc. led the decline, down more than 3%. Chip stocks also added to weakness in the overall tech sector, with advanced micro devices and NVIDIA down more than 4% as investors price in the prospect of supply chain disruptions following this surge in COVID-19 cases in China. Mass testing is underway in Beijing following an increase in COVID-19 cases, which has stoked fears that China's capital could face a Shanghai-style lockdown. Treasury yields, meanwhile, continued to lose ground as investors price in the prospect of slowing global growth at a time when Russia-Ukraine war, which continues to intensify, has returned to focus. Excuse me. Russia's Foreign Minister Sergei Lavrov said that if the U.S. and its allies continue to provide Ukraine with weapons, there's a risk of the war escalating into a wider conflict with NATO nations. Let me stop there. Russia, if you want to vaporize Washington, D.C., I think most Americans would not give a shit at all. We're kind of tired of being robbed by those thieves. And, I got friends that live in the area, but you know what? I'm willing to lose a few of them to have relative freedom again. So, all right, let's jump back in. Beyond the wreckage in tech, financials also exacerbated the sell-off, paced by a decline in regional banks amid weaker quarterly results and following Treasury yields. Zions Bank Corporation fell more than 8% after Raymond James downgraded the stock to market perform from underperform after the bank reported first quarter revenues that fell short of estimates. General Electric, a major Dow component, slumped more than 10% after the conglomerate's cautious tone on guidance overshadowed first quarter results that beat on both the top and bottom lines. GE CEO Lawrence Culp said the company is, quote, trending toward the lower end, end quote, of its guidance provided in January, citing inflation pressures and the war in Ukraine. 3M also reported better than expected quarterly results, but flagged rising cost pressures and weaker demand for masks ahead. They could keep a lid on growth. Its shares were down nearly 3%. Energy bucked the broader trend as oil prices rose back above $100 a barrel as demand fears eased somewhat after China said it would support its economy as another lockdown potentially looms. The wave of earnings so far has failed to impress investors as inflation has shifted from a tailwind for stocks to a headwind, pressuring expectations about future earnings. Earnings revisions breadth for the S&P 500 has resumed its downtrend over the past 2 weeks and is once again approaching negative territory. Morgan Stanley chief equity strategist Mike Wilson wrote in a note on Monday. Lots of bad news. Earnings wasn't good, or at least didn't really impress those who really dive into those numbers. But we'll see. All right, next article: oil snaps 3-day slide on short covering. U.S. inventories awaited. It's written by Bharani Krishnan. Crude prices rose as much as 3% on Tuesday, rebounding after a 3-day slide that took a barrel of oil below the $100 support, triggering short covering. Imminent data on U.S. oil inventories expected from both industry group API and government agency EIA. Also led buying on dips by market participants since Monday's settlement. Brent crude, the London traded global benchmark for oil, settled up $2.67 or 2.6% at $104.99 a barrel. Brent lost 4% in previous sessions, extending last week's 4.5% slide on Monday. It touched an intraday low of 99.26 as top oil buyer China grappled with a new COVID surge, and the Federal Reserve appeared bent on doubling down on U.S. rate hikes. Why would the Fed not raise rates? I mean, we have horrible inflation. Why would they stop that just because oil is expensive? WTI, the New York traded benchmark for U.S. crude, settled up $3.16 or 3.2% at 101.70 in Tuesday's trade. On Monday, WTI lost 3.25%, touching an intraday bottom of 95.31 after a 4.5% slide last week. Quote, the $95 low on WTI has been a tough nut to crack, and since we went there yesterday without really going below it, it triggered a wave of short covering, end quote, said John Kilduff, founding partner at New York energy hedge fund Again Capital. Market participants were also on the lookout for U.S. weekly oil inventory data due after market settlement from API or the American Petroleum Institute. The API will release at approximately 4:30 p.m. Eastern Time a snapshot of closing balances on U.S. crude, gasoline, and distillates for the week ending April 22nd. The numbers serve as a precursor to official inventory data on the same due for U.S. Energy Information Agency on Wednesday. For last week, analysts tracked by investing.com expect the EIA to report a crude stockpile build of about 2 million barrels. versus the 8.02 million barrel reduction reported during the week of April 15th. On the gasoline inventory front, the consensus is for a draw of 761,000 barrels over the 976,000 barrel decline in the previous week. With distillate stockpiles, the expectation is for a drop of 2.66 million barrels versus the prior week's slide of 829,000. So looks like oil has sort of stabilized. We'll see what happens over the longer term. Again, until we really get inflation under control, I really don't see the price of oil coming back down before then. All right. U.S. business spending on equipment is strong. House prices push higher. It's written by Lucia Mutakani. New orders for U.S.-made capital goods rebounded more than expected in March, suggesting that business spending on equipment ended the first quarter with strong momentum, though part of the increase reflected higher prices. While other data on Tuesday showed a dip in consumer confidence this month, households were eager to buy big-ticket items like motor vehicles, television sets, and clothing dryers within 6 months. Consumers were also inclined to buy a house despite surging mortgage rates and record home prices. This implies that the economy will continue to expand through a moderate pace amid higher borrowing costs as the Federal Reserve tries to quell soaring inflation, ignited in part by massive COVID pandemic relief money. Hey, at least they're admitting it now from the government and from stretched global supply chains. Quote, despite all the hand-wringing over rising interest rates and high inflation, and overlooked positive for economic growth is the fact that capital spending remains intact, said Tim Quinlan, senior economist at Wells Fargo in Charlotte, North Carolina. Quote, while demand may soon slow from the breakneck pace over the past 2 years, we need to replenish still depleted inventories. Inventory levels will keep orders rolling in. Orders from non-defense capital goods, excluding aircraft, a closely watched proxy for business spending plans, increased 1% last month, the Commerce Department said. These so-called core capital goods orders fell 0.3% in February. Economists polled by Reuters had forecast core capital goods orders would rebound 0.5%. The data are not adjusted for inflation. Surging labor costs amid worker shortages also expected to keep demand for equipment strong as businesses seek labor-saving technologies. There were strong increases in orders for electrical equipment, appliances, and components, as well as computers and electronic products, machinery, primary metals, and fabricated metal products. Orders for transportation equipment advanced 0.2% after plunging 4.4% in February. Motor vehicle orders accelerated 5% after rising 0.3% in February. Orders for volatile civilian aircraft category dropped 9.9% after decreasing 27.3% in February. Overall orders for durable goods, items ranging from toasters to aircraft that are meant to last 3 years or more, increased 0.8% last month after declining 1.7% in February. The Fed increased its policy interest rate by 25 basis points last month. The U.S. Central Bank is expected to hike rates by 50 basis points next week and soon start trimming its asset holdings. Though shipments of core capital goods rose 0.2% last month, matching the gain in February, that followed a hefty increase in January, leaving business spending on track again to contribute to gross domestic product growth in the first quarter. Core capital goods shipments are used to calculate equipment spending in the GDP measurement. Demand for goods remains strong, even as spending is shifting back to services, keeping manufacturing expanding. But the sector, which accounts for 12% of the economy, continues to battle supply bottlenecks, a situation that has been worsened by the war in Ukraine, which has slowed the recovery in global supply chains. Lockdowns in China to contain a resurgence of COVID-19 cases are also adding to the strain. The government is due to publish a snapshot of first quarter GDP on Thursday, according to a Reuters survey of economists. GDP growth likely slowed to a 1.1% annualized rate last quarter from the fourth quarter's robust 6.9% pace. Stocks on Wall Street were trading lower. The dollar rose against a basket of currencies, and U.S. Treasury yields fell. There's also a slip in consumer confidence here. The slip in consumer confidence in April came as households grew less upbeat about current conditions. The Conference Board's Consumer Confidence Index nudged down to a reading of 107.3 from 107.6 in March. The index remains above its pandemic lows, and consumers' perceptions of the outlook improved despite the conflict in Ukraine, which has contributed to higher gasoline and food prices. That is a lie. Gasoline and food was more expensive well before Vlad got the urge to take back some of his land. So, all right. The survey, so-called labor market differential, derived from data on respondents' views on whether jobs are plentiful or hard to get, fell to a still high 44.6 this month from a reading of 47.1 in March. The measure correlates to the unemployment rate from the Labor Department. The jobless rate was at a 2-year low of 3.6% in March. There were a near record 11.3 million job openings on the last day of February. Consumers' inflation expectations over the next 12 months fell to 7.5 from 7.9 in March. The share of consumers planning to buy appliances was the largest in 8 years, but fewer planned to go on vacation within 6 months, with the share of domestic travel falling, likely because of higher gasoline prices. Many intended to vacation outside of the country. Plans to buy a house climbed despite the soaring mortgage rates and record house prices. The housing market is being closely watched for signs of cooling demand due to the Fed's monetary policy tightening. A third report from the Commerce Department showed new home sales plunged 8.6% to a seasonally adjusted annual rate of 763,000 units in March. The third straight monthly decline in home sales has likely reflected a dearth of entry-level homes, with nearly all new homes sold above the $200,000 price level. The 30-year fixed rate mortgage averaged 5.11% during the week ending April 21st, the highest since April of 2010, up from 5% the prior week, according to data from mortgage finance agency Freddie Mac. With inventory tight, house prices continue to soar. Another report showed the S&P CoreLogic Case-Shiller's 20 metropolitan area price index surged to a record 20.2% on a year-on-year basis in February, after increasing 18.9% in January. Hefty price gains were recorded in a number of cities, including Los Angeles, Seattle, San Diego, San Francisco, Phoenix, Tampa, and Miami. Strong house price inflation was reinforced by another report from the Federal Housing Finance Agency showing home prices accelerated 19.4% in the 12 months through February, after rising 18.3% in January. Quote, housing demand will cool over the rest of 2022 and home price increases will slow, said Bill Adams, chief economist at Comerica Bank in Toledo, Ohio. Quote, even so, national average home prices will still be up by double digits at the end of 2022 from the end of 2021. So, yeah, if you're in a home, it's great. I mean, my house has gone from, a little under, 500,000 to up over, in the mid 800s just in 5 years. So, I mean, I'm not that upset about it, but unfortunately, with interest rates going up, I'm not going to get another 3% interest rate anytime soon. So, as far as moving up to something different, unless I'm paying cash at some point in the future, I don't think that's going to happen. All right. Last article I got here has to do with some market commentary. A secular bear market is here, says this money manager. These are the key steps for investors to take now. Let's see what he has to say. Who wrote this? Barbara Kohlmeyer is the author. Turnaround Tuesday is looking wobbly as stock futures slip ahead of big earnings from Microsoft and Alphabet after market close. These results could provide a fresh catalyst for market direction after Monday's mega reversal that some aren't trusting. Also wary these days is RTM Capital Advisors Chief Investment Officer Mark Ritchie II, who sees a lot of trouble under the hood. I would agree with Mark. Let's see here. When the market, quote, let me start again. Quote, when the market is grappling with too many things at one time, it's generally a headwind, meaning the more managers have to discount too many issues, the more they have to tighten up on risk. Ritchie said in a Monday interview with Real Vision. In our call the day, he warns of a, quote, secular bear market environment where prices can underperform average gains for years, with solid advice for investors. Among his worries, he noted just 20% of NASDAQ stocks are currently above their 200-day moving averages. Quote, I'm not saying we're going to go 10% lower in 3 days, but every time that happens, it happens in an environment like we're sitting in, where there has been distribution dominating the tape. We're trading below technical areas of support, and there's very little leadership, end quote, he said. For retail investors especially, another big theme is worth watching. Quote, the market has been reinforcing certain risk management strategies that I think are being challenged and have been challenged over the last 18 months. I don't think that it is over, end quote. Those include the popular strategy of buying the dip after market sell-offs. Quote, over the last decade, everyone has slowly adopted this idea of maybe it's the Fed that will bail me out, or there is no alternative, he said. The casualty list over the past year, tech dip buyers, long short equity traders who decided they didn't need to use stops with GameStop, or 60-40 managers who decided instead of pairing risk, they bought more bonds, he said. Bonds and equities continue to fall in tandem, he cautioned. Quote, how many people have been conditioned in a larger sense to say that the Fed has my back? And as I see it, the Fed is saying heads we're going to raise rates, tails we're going to raise rates even more. Either scenario, we're going to withdraw liquidity now that it's not, generally speaking, the most bullish fundamental driver either. As for safety, he's got a small position on gold, but he wants to see technical shape up better. But he sees bullish setup for oil as nothing in the supply demand situation has changed. That's especially coming into a strong seasonal period. Quote, I think if we make new highs, this break has brought some of the shorts back in, and there are enough people on the other side of the trade now that I think a break higher is potentially even more powerful in the short run, end quote. But a crude weekly close below 95 or 90 would mean the bears are in control. So, well, as we know, crude went back up today. So I think in his opinion that we're going to see another leg up in the price of oil. He said he has been saying for months that investors need to be raising cash, and that's still the case, even if indexes perk up, because it's pointless to try and pick winners right now, as the leaders in the next cycle may be different. That cash gives investors flexibility to bend with the market. Quote, so you get a rally attempt, you put a little bit of capital to work, and then you build on success or failure, he said. So dip a few toes in, then go waist deep if that's working. That's a strategy he applied after the COVID-19 lows of 2020. Last thing, volume matters. Rally attempts are predicated on the market having closed higher and above average volume several days after the low, meaning you're getting subsequent buying. Every meaningful rally in history of the stock market has had valid accumulation days coming or for days after the subsequent low. So again, I'm not the only lone person out there who thinks things are going to hell. But again, be careful. The people I work with, I've already made some major adjustments much earlier this year and also last year. So we've just been sitting and waiting for things to fall apart. And not to say there aren't some things I'm going to do here in the coming weeks, but the best time to the best time to prepare for something horrible is, well before the bad things happen. So it's kind of like hurricane season down in Houston. When you got a storm coming at you, you got to board up your windows, get stocked up on food and water, make sure you've got batteries and stuff for your radios and flashlights. Now's the time. Well, I mean, I think we're kind of at the precipice if things go to my own personal forecast. But hey, we'll see. All right. Well, that's everything I had for today. I hope everyone gets something valuable from my ramblings. If not, I will try harder tomorrow, guys. I'm always trying to do a little bit better. So, all right. Well, that's everything I had for today. I hope everyone has a fantastic evening. We'll be back tomorrow with Wednesday's Liberty Call, and y'all have a good night. Bye.